All right, welcome back. We're still working on merchandising businesses, and we start off with a quick little review. And this will have a little bit of a different twist to it this time. Instead of looking at journal entries, we're going to look at more or less ratios here. Let's start out with what we should already know. How exactly do we calculate the current ratio? What information does it give? And determine how to actually calculate it using these figures down here. Now this probably gives it away. I'd encourage you to pause at this point and see if you can do these questions. Current ratio is calculated as current assets divided by current liabilities, where current assets are assets which can be liquidated within 1 year. Current liabilities are things or debts that are due within 1 year. And what exactly does it tell us? Well, it tells us the ability of a company or business to pay its short-term debts. And we say short-term because we're looking at things that happen within 1 year. So if we want to look down here, we've got our current assets, which are 60,000, current liabilities are 50,000, and if we want to calculate our current ratio, it's going to be 60 divided by 50, which is 1.2. So moving on to our question for thought and what we're going to look at today, and that what we've just done does relate to what we're going to get to look at in this lesson. What happens if the value of inventory decreases? For example, a computer that used to cost $1,000 is now only worth $750. Well, we're going to take a look at the accounting rules behind that. And which good would you rather be selling and why? We've got good A, average inventory 30,000, sell, cost of goods sold 30,000. Good B, $60,000 worth of inventory and cost of goods sold 40. And finally, good C, which is average inventory 13,000 and cost of goods sold is 39,000. And here's a multiple choice question. Is inventory an owner's equity account, current asset, fixed asset, current liability, or long-term liability? These are the questions we hope to answer in this lesson. So moving right on in, we've got adjusting inventory and liquidity ratios. We're going to start off with this adjusting inventory. So going back to that question, what happens when we have inventory that is written down, or well, it's different. We bought it maybe at 1,000 and it's actually worth 750. Well, when inventory is written down to the lower of its cost or market net realizable value, this follows the conservatism rule. Cost of goods sold are debited and inventory is credited. So just to review, conservatism is the practice of choosing, when in doubt, an accounting method that is least likely to overstate the assets and then the net income. Ultimately, we're trying to have accurate financial statements. So let's take a look at an example. Lenovo's inventory shows the following information about tablets and laptops. December 31st. Journalize the entry to adjust the inventory according to the LCM. And we're not talking lowest common multiple, we're talking lower of cost and market. So take a look at these numbers here, pause the video, and see if you can figure this out. Alright, now that you've had a chance, let's take a look at this. The LCM, the lowest cost market for these tablets will be, well, the lowest of these two numbers, which is 2,000. And what's the lowest cost of these laptops? Well, market value says 2,000. So our total inventory is not 7,000 or 5,000. It's in fact 4,000. 2,000 plus 2,000 gives us 4,000. And so that means that we need to have an adjustment of, well, our current value on books is 7,000, so we need to adjust it down $3,000. So here is our journal entry that's involved. Cost of goods sold 3,000, merchandise inventory gets credited to show that it in fact did decrease, and a little note at the bottom to comment to record a decline in inventory value. And so there you now know how to adjust the inventory balances when the market price of something goes down. Take a look here, we are now getting into some ratios. In this case, we're looking at an inventory ratio. And yes, this looks super yummy. We're not talking about Apple turnovers. This is in this case inventory turnover, unless of course you're selling pastries. This ratio measures the number of times on average inventory is sold during the period. So we take inventory as being the cost of goods sold divided by the average inventory. And how exactly do we calculate average inventory? We've got the starting inventory plus the ending inventory divided by 2. And the higher inventory indicates that there's more efficient sales are being made. So let's go take a look at some numbers. Oh, wait, we're not there yet. This is the second part of those ratios. So we're going to actually take that inventory turnover. So that's what we calculated here. And we're going to be able to calculate what we call days sales in inventory. And this converts the inventory ratio, instead of a ratio, into a measure of average of the inventory will be on hand. The lower the ratio, the better, because it basically says that you're selling your inventory super fast. Now, of course, different industries will have different day sales and inventory. For example, you would expect things in the dollar store should be fairly quick to sell, but when we're talking about vehicles, they'll probably be staying in inventory a little bit longer before they actually sell out. Maybe even cakes would be a super fast inventory turnover. So I'd encourage you to pause the video at this point, see if you can apply yourselves, and complete this chart. Alright, now that you've had a chance to go through these numbers on your own, hopefully paused and taken the time, the 5 minutes to do them, let's take a look at what the actual answers will be. Well, starting inventory, ending inventory, 25, 35, adding these together gives us 50, 60. 60 divided by 2 is going to be 30, so that tells us that our average inventory cost is 30,000. 30 divided by 30 will give us an inventory rate or inventory turnover ratio of 1, which means that 365 divided by 1 will then be 365. Alright, there's the first line done. Let's take a look at the next one. 50 plus 70 is 120. 120 divided by 2 is 60. So the average inventory cost here is 60,000. 40 divided by 60,000 will then be 0.66666, but we round to 0.67. 365 divided by 0.67 will indicate that this number will be greater than 365, and that's where we pull out our calculator, and we get 547. 15 plus 11 is 26,000, and 26 divided by 2 is 13, and so 13 here. 39 divided by 13 indicates that the inventory turnover ratio is 3. And if we take 365 divided by 3, we end up having a number of 121 point something. In that case, that something is 0.7. So what exactly do we see? The ratios above indicate that the last company, this one right here, is able to sell its inventory 3 times on average throughout the year, which is an average of 121.7 days in inventory. So essentially, if you had inventory right now, and you were this company at the very bottom, it would take you about 121.7 days to sell all of that material, whatever is there, and it's all gone. The other products sell much slower and turnover is less during the year. That's what these other numbers tell us. So if, for example, with this first company, it tells us it would take about 1 year to sell whatever is in inventory for this company. Again, different companies have different turnover ratios or rates. So we jump right in. We've looked at some liquidity ratios. Let's just take a look at where we are right now. They measure the short-term ability of a company to pay its maturing obligations and meet up unexpected needs for cash. And what we've learned so far in this course and in grade 11 would be working capital, which isn't as good as looking at current ratio, because the current ratio is a ratio, and this just looks at numbers, and this can be super misleading depending upon the size of the company, whereas ratios take into account the size of the company, inventory turnover, which you just got to see, and days sales in inventory. So let's just take this with a grain of salt and understand why we started with this current ratio and where we could get some inflated numbers, and why we need to take a look at books very carefully to understand where numbers come from and what they do. So remember that number, those numbers at the very beginning of the lesson. Well, there's a current ratio coming from $60,000 in current assets and $50,000 in current liabilities. And this indicates it's 1.2. Looks pretty promising. Well, down here, our inventory information for 2012, average inventory is 50,000 with a cost of goods sold of 10. Now, what exactly does this tell us? Well, it tells us that our inventory is 0.2. It's pretty darn slow. And here's the problem. That inventory turnover, or inventory, is in fact a current asset. But it's actually taking a really long time to sell it. In fact, it would take you 1,825 days according to these averages. So what exactly happens? Well, since the inventory is so slow to sell and it accounts for such a large portion of the current assets, it inaccurately inflates the current ratio. So this is something to be aware of, that you can't just go and look at a company's ability to to pay its debts just based upon the current ratio when we're talking about merchandising businesses. In fact, we should take a closer look at these inventory turnover rates or ratios before we can make any conclusions about its ability to pay its debts. And that is it for right now. I hope you've enjoyed. If you ever have any questions, reach out to me. I'm always happy to answer them. Enjoy until the next one.